we're value investors. We prefer to buy cheap stocks. We use an active bottom-up approach with a fundamental analysis to select those securities. And for us, we like to identify companies that they're not at peak profitability. And to come back to this as with the name we talk about today, but we have within the process some elements that we believe help us in avoiding value traps and protecting us on the downside, especially if we're not being compensated for that. And again, we want to buy when companies are not at their best, necessarily their best of days. We're looking for them to do better in terms of financial performance and also in terms of valuation. And today we're obviously here for the European Summit, and I thought, well, why not speak about a European industrial, and an area where I believe Europe thrives over the long term with good companies. I chose to speak about this Swiss company, SFS Group. While not the cheapest company on traditional metrics, it has, I believe, very decent quality attributes. SFS manufactures application critical components and assemblies. There is a founding family here, as you'll kind of often find with smaller European groups, that owns more than half of the shares. SFS is a global player. They have developed over time well in terms of sales and profits. You can see that they're roughly around 3 billion Swiss franc of sales currently. The last few years, growth has been much harder to come by, and that's something we're gonna touch on today. So what do they do? SFS Group operates in three main segments. They each have different business models. First, the engineered components. It is roughly a little more than a third of sales today. In this segment, what SFS is doing is they are acting as a development and manufacturing partner for customer-specific precision components, assemblies, and fastening solutions. They serve key end markets such as automotive. So think of them serving the tier one auto suppliers. They have important business in electronics for hard disk drive companies like Seagate as an example. In medical, so they would be working for the likes of Stryker or Johnson & Johnson. And then also in industrial specialties as well. In this segment today, SFS has operating margins of roughly 14%. And then there's the fastening system segment. So roughly about 20% of sales today. This segment is similar. They develop, manufacture, and market application-specific mechanical fastening systems, and this is primarily for the construction industry. And think of roofing systems and facade systems. That is typically where they are doing their work. And they have operating margins here of roughly 12% at the current time. And then finally, there's the largest segment, at least in terms of revenues. This is distribution and logistics. And here, SFS is recognized as one of Europe's leading distribution partners for direct and indirect materials. Its offerings in this segment include quality tools, fasteners, other C parts, and procurement solutions for customers in industrial manufacturing and construction sectors. Overall, across the group, SFS has 270,000 customers, and many of those customers are going to be in this segment. This segment has the highest bias toward Europe. Roughly 90% of sales here are in Europe. It's a little bit lower margin here, it makes sense, but the operating margin here today is roughly around 8%. So the share price history here, SFS Group was IPO'd in 2014. And post-IPO, you can see they were on a good run. They were impressing investors with strong results and returns on capital employed. Then they hit a soft patch for the share price with the kind of original trade war fears back in late 2018. This caused a bit of a German growth scare, at least in terms of investor sentiment. And the share price will react to that if investors are fearful of industrial weakness in Europe. COVID comes along, of course, and the company traded quite well through that, actually, as a business, despite auto production weakness. Their results were down just a slight touch in 2020. 2022 brought a very interesting year for the company. We obviously had the Ukraine war, and that impacted the cost side for many of their customers. There's still severe supply chain issues in industries like auto and electronics. And then within that year, SFS made one of the largest acquisitions in their history by acquiring Hoffman. And Hoffman, they grew the D&L segment significantly. You saw before, it's more than 40% of sales. It really internationalized that segment with this acquisition because previously SFS was largely confined to Switzerland in that business. Since that time, the share price is reflecting that SFS is suffering from the industrial weakness in Europe. Overall, SFS is a business with 70% of revenues in Europe. So they have had quite stagnant financial results. But basically what this chart shows us is we have a share price today that is roughly the same as it was in early 2018. So what do we find attractive? First is that SFS is a mission-critical value engineering specialist. SFS would tell the story that these components are often only 1% of the manufacturing cost for their customers. But SFS really gets embedded with the customer to understand the total cost of what that customer is doing. And SFS can engineer their precision component to lower the overall cost for the customer. Those savings can be in logistics, manufacturing time, assembly, reliability, and performance. And then, of course, the customer retains that extra value. And the customer will then be loyal to SFS the next time they want to engineer a new product. SFS is doing this for quite a well-diversified customer list: automotive, medical, aerospace, electronics. Now, in construction, the fastener segment, it is slightly different. They're engineering with value for the application. That application, say a facade, could potentially be reused in the fastener segment for other customers. Also important with SFS is they have the local for local approach. So they go where their customers are, more than 100 sites, and their strong scale at what they do is reflected in those strong margins and returns. There's a strong financial profile. Returns on capital employed are typically above 20% for SFS, low financial debt, and they convert much of their cash flow to free cash flow. At Ballina, we like free cash flow, and this company generates it. And finally, human capital has to be mentioned. SFS are believers in the dual education approach. Many of their employees are going to school today or have gone to school, and that was paid for by SFS. And this allows them to have a growth mindset with their human capital, and they're essentially growing their future leaders and their innovation. So I teased this a bit already, but why do we have the buying opportunity here? The final 2024 figures, when they came out early this year and they gave an outlook for 2025, that did not fit what the market had come to expect, and this led to some share price weakness. And really, the economy has to be something we have to talk about here. So 70% of the business is in Europe. Much of that, the biggest markets for them are Germany and Switzerland. And really, for me, I believe the best indicator for what can drive them or what ails them is the fabricated metal products IFO survey in Germany. And you can see there on the right, it has been basically negative year on year since the middle of 2023. Now it is heading in the right direction by getting less bad, but things are still declining. So that's the main reason we're kind of here getting the opportunity to talk about SFS. Currency is also an issue for reported figures. SFX is actually growing their top line modestly today, but on a reported basis in Swiss franc, they are not. And that's because of the Swiss franc. And lower capacity utilization, this is a really important point. To manufacture these customer-specific components, this requires a lot of capital expenditure. And it works best when these facilities have high volumes and the high utilization of them. This hasn't been the case for a few years for SFS. And one can imagine that the industrial footprint that one can develop when you are being, local for local, going where their customers are, given the span of time, some of these locations will prove to be less productive. And this is what SFS has been experiencing in the last few years. They've highlighted, sites in Czech or Hungary that don't have the scale today. And so what they have done is they have announced that they will close some of these lower volume satellite locations, and then they'll consolidate volume back in their larger locations. Over the next few years, what this should do is add back 80 basis points to the operating margin of the group. Now, together with the fewer locations, SFS have also streamlined the executive board. So there are now fewer divisions. The executives are more customer facing. They believe that decision-making will be faster as a consequence and should benefit growth. Now, I have tariffs listed here. It's a relatively small impact, so I don't want to overstate this, but in the D&L segment, some of their industrial customers, it makes sense. They have been uncertain about the outlook, and orders haven't been, robust from the US. So those customers are not moving forward with activity, and this has hurt their D&L segment a bit. So all of this has led to a group where the revenues and profits look quite stagnant. Eventually, SFS hopes to get back to being a group that grows top line 3 to 6%, and the margin targets are higher across all the segments than what we see today. And in a normal, more healthy market backdrop, the goal is to get to that 3 to 6% organic top line target. One should know that the median organic growth for SFS from 2017 to 2021 was 4.3%, and the operating margin through that time was 14% median. So relative to today, they're growing organically about 1%, and they're having EBIT margins closer to 11%. In the first half of 2025, what I think is interesting is that they grew 4.7% with their top 20 customers. So that is a pretty good indicator of the overall health and traction of their core customer base. And it really starts with that value engineering model focused on overall product-related costs. Following SFS, you can see very clearly they're focused on the future. Electrification, miniaturization, digitalization. These are all things that they're investing in. And within their important verticals, they do spend quite a bit on R&D. They are not really building components for the past, but it's very much on the front foot in these verticals, especially in automotive, but also electronics. SFS invests CapEx in normal times about 6% of sales. This is going into all of their sites, but also into new sites. Heerbrugg, Switzerland, the home base has received significant capex, but also they have built a base in Nantong, China, and that's been getting capex as well. Acquisitions, so they can make acquisitions. I refer to the Hoffman deal in the D&L segment. They make mostly smaller acquisitions, and more recently, these deals have tended to be in the fasteners segment, but they can find acquisitions in all of the segments. And I think over time, it would rebalance them more towards North America and Asia. So if you think about that profile where they're 70% Europe today, and we think there's definitely recovery potential, right, of Europe, but 70% Europe today, if they get to where they want to be, it'll be 20% North America and 20% Asia, so that Europe would resize to 60%. And that will be with the help of acquisitions to get them there. And that is the final point. Asia is just about 14% of the business today, but growing, and they see more opportunity in, for example, India. Balance sheet is important to us at Ballina. I started my career way back when with credit training, and so balance sheets are always important to me. We believe SFS has a strong balance sheet. They moved into net debt when they did the Hoffman deal in 2022, and since then they've been deleveraging, and the equity ratio is back where they are more comfortable now. In terms of valuation,